So Dave, can you explain the creation and redemption process in less than 30 seconds?
Oh
Ready?
boy, I'll try. I'll try. All right, so
Hi, I'm Ren Leggi, Client Portfolio Manager with ARK Invest. On this season of The Switch, we're going to address the mechanics of exchange-traded funds. As always, we'll be joined by ETF Trends to facilitate the discussion and make sure that we don't leave anything unanswered. So let's get the conversation started with the creation and redemption process. So Dave, can you explain the creation and redemption process in less than 30 seconds?
oh
Ready?
boy, I'll try. I'll try. All right, so with a regular old mutual fund, when you give money to the mutual fund, it sits there in cash. They go buy a bunch of stocks for you. Really simple. With an ETF, it's a little different. You as an individual don't give money to ARK or any other ETF issuer. Instead, you buy shares on the open market. There's a kind of participant called an authorized participant. They're the only ones who are allowed to give money to the fund company, but they don't give them money. They give them whole baskets of stock. So what that means is money goes in and out of the fund only in whole slices of the portfolio or specific stocks or securities that portfolio manager actually wants. This has all sorts of implications. From an investor's perspective, what it means is you can trade this anytime you want in the open market, and you don't have to worry about how that money actually ends up in the portfolio. But Ren, what does it mean for a portfolio manager when you don't have to worry about cash going in and out of the fund?
Well, you can focus 100% of your time on the portfolio management and portfolio construction process. All right. So, we've experienced a lot of inflows, in a short amount of time, but we weren't concerned about liquidity because we were receiving those shares in kind through the process you just explained, right? So we receive pro rata shares in kind when we receive those creation units. Now, the same is true. Now, the concern out there is well, what if you have the reverse happen and you see a massive amount of redemptions? Same is true on the back end, right? Where we provide those shares, the underlying shares, to those authorized participants. It's their job to create liquidity, right? They're paid very well to do that. They either keep it on their books, they sell it in under open market, they cover shorts. There's a number of ways that they can unload those positions, and so it doesn't have an impact from our perspective, from a portfolio management perspective. And that's one of the advantages of having this growth in ETF wrapper.
Yeah, and Dave, with $6 trillion in ETFs, the vast majority is index-based, and that's why most investors feel that they're tax efficient because they're index-based, when in fact, it's because of the structure. So talk a little bit about a case like ARK where they've got high conviction in certain stocks, but they may sell them. But how can they do that and not show capital gains or losses?
The beautiful thing is most of the time, if there is a redemption, right, if all of a sudden $20 million wants out of the fund, as Ren said, they hand those portfolio securities back out to the authorized participant. There's actually no sale. And the same thing happens on the way in. There's actually no purchase when it comes in. So the ETF can constantly be resetting its cost basis higher and higher and higher. That means that even if ARK is doing some trading on a day-to-day basis, taking a little profit or reallocating into something that might be beaten down, those small gains on a day-to-day basis are offset by that constant washing of the basis because of creation and redemption. So it's kind of beautiful. It just means as an investor, you only have to worry about taxes on your experience when you buy and when you sell.
And Dave, I'd add, right, from being an active manager within the ETF wrapper, we even have an advantage over the passive, right? Some passive ETFs are on a set rebalance, right? So they're forced to trade on certain days. We never are forced to do anything because we're active, right? And so we will pick our opportunities. We can be in some market environments a liquidity provider where we're buying very aggressively, maybe in a down market. Or we could be sellers of names and creating liquidity for others and maybe even those authorized participants of other ETFs. So, that's one of the beauties, I think, that go kind of overlooked because basically the category of actively managed ETFs are just so new.
Yeah, I mean, in some ways, you get the best of both worlds, because not only can you actively trade from your trading desk, but you can also use that authorized participant as kind of a relief valve to move securities in and out of the portfolio as the market wants your funds.
And we all remember back in the financial crisis, and after that, when we saw huge redemptions coming out of mutual funds, those shareholders that actually had the guts to stick around were given this holiday bonus at the end of the year in the form of big capital gains distributions, because they had to sell low-cost basis stock to meet the redemptions. We haven't seen big bear markets in a long period of time, but that will be coming again one day in the mutual fund world, right?
Right. I mean, that is one of the things people often talk about ETFs, not just being tax efficient, but really tax fair. Right? The fact that somebody got out of your mutual fund 7 months ago shouldn't give you a tax problem, right? And so ETFs really do make it much more tax fair.
Thanks, Dave and Tom. It's been a pleasure speaking with you. I'll see you on the next episode.
Thanks, Ren.
Dude.